Welcome to the Deep Dive. Today, we're really digging into something fascinating. We've got a collection of recent research papers here from Market Pulse, June 2025.
Hmm.
And we're going to re-examine how you might think economies actually work. Our mission really is to light up this critical theme running through all these papers, how things like institutional design, rules, regulations, even financial instruments, they don't just sit around markets, they fundamentally shape them, how efficient they are, how risk gets spread around, maybe even fairness, economic equity. We'll unpack some surprising stuff, look at different market structures, and yeah, see what it means to you.
Yeah, that's a really key point, isn't it? Because we often just think, supply and demand, that's it. Markets just happen. But this deep dive, it really shows how the man-made stuff, the rules, the regulations, these clever financial tools, they play just as big a role, maybe even bigger, in whether a market actually succeeds or fails. We'll connect the dots across some really different areas, too, from state-owned companies in India to, U.S. bond markets and even the fallout from trade wars.
Okay, great. So let's jump into that first insight, this idea. What if improving government-owned companies isn't about selling them off? What if it's just about giving them more, well, freedom? It definitely goes against the usual thinking.
Absolutely. That's exactly what Namrata Kalla's study digs into with Indian state-owned enterprises, or SOEs. She looks at this 1997 policy in India. They called it earned autonomy. And the research, it really challenges that, standard wisdom that privatization is the only way to get these companies performing better.
Right, and the way they gave out this autonomy was quite specific. It wasn't just a free-for-all. Certain SOEs, the profitable ones that met the criteria, they got different levels of freedom. Mini-Ratna Category 2, Category 1 of Ratna status,
Yeah.
basically letting them make big calls on capital spending, training joint ventures.
Without running to the government first for approval, they just had to sort of notify them after the fact.
Exactly.
And the results were pretty striking. This autonomy, it led to significant jumps in value, added about 5.4 billion rupees. Capital spending went up too, roughly 11 billion rupees, and even wages increased by over 756 million. Quite substantial.
But here's a really interesting bit, I think. The study found no significant effect on productivity. None. And they didn't see a shift towards using more temporary workers either, which suggests these SOEs kind of held on to their social goals, like, providing stable jobs. So that raises a big question, doesn't it? If productivity didn't budge, why focus on those other metrics? What does that tell us about what the policy was really trying to achieve?
That's a great point. The no productivity finding is what's quite revealing. It really challenges our standard assumptions about what success looks like for any reformed company, especially a public one. It suggests that maybe, just maybe, for these public sector firms, success isn't only about cranking out more stuff per worker. It could be about broader things like job stability, maybe equitable growth, even if it doesn't show up immediately as a productivity jump.
So a different definition of performance almost.
Exactly. It forces us to think about what performance truly means in that public context.
Okay, so if we broaden the view then, where did this autonomy have the biggest impact?
Well, the study found the effect was strongest in firms where there were bigger agency conflicts beforehand, where management's goals and the government's goals weren't quite lining up. So giving autonomy seemed to align decision-making better with who actually had the information. And interestingly, autonomy also went hand in hand with better access to private finance.
Ah, so the market saw it as a positive signal.
Precisely. It showed increased market confidence. So it really backs up the idea that strategic freedom, good governance, can boost performance even if the ownership doesn't change hands.
Okay, so that's fascinating how internal design in SOEs matters. Now let's shift gears, zoom out to the huge U.S. bond markets, trillions of dollars here. And this is where it gets really interesting, I think, because you see how market structures, even ones designed for efficiency, can still, well, buckle under pressure.
Definitely. Let's start with the U.S. corporate bond market that's about $11 trillion. It's seen a huge change. It used to be mostly dealers making the market. Now you see a lot more retail investors, more ETFs, and a big shift towards electronic trading, especially these RFQ platforms.
Request for quote, right, where buyers ping multiple dealers for prices at once.
Exactly. And that's led to this sort of split personality for liquidity.
How so?
Well, under normal conditions, liquidity has actually gotten better, especially for the big, actively traded investment-grade bonds on those platforms.
Yep.
But it seems much more fragile when things get stressful. In those moments, the old-school dealer relationships suddenly become really important again.
And why is it more fragile now? Regulations.
Largely, yes. Post-2008 rules like Dodd-Frank, the Volcker Rule,
Mm.
they limited how much inventory dealers could hold, basically reducing their capacity to buffer shocks. And at the same time, you had this explosion in bond ETFs and mutual funds, which is great for access, but it also introduces new risks, like everyone trying to sell their fund shares at once during a panic. Redemption risk.
Right, the dash for cash.
Yeah.
But the market hasn't totally broken down, has it? There's some resilience.
Oh, yeah, definitely. You have long-term investors, think insurance companies, who often step in and buy when others are selling off. They act as stabilizers. And during the COVID shock, remember, transaction costs just blew out like 90 basis points, nearly 1%, just to trade top-rated bonds.
Wow.
Yeah. The Federal Reserve actually had to step in, become the market maker of last resort, essentially, just to keep things flowing.
Okay, so corporate bonds. Improved daily liquidity, but fragile under stress. What about the municipal bond market? The muni market, that's huge too, right? About $4 trillion?
It is, but it's a very different story. Unlike corporates, the muni market seems kind of stuck with these persistent, costly problems. Think opaque pricing, not much transparency, incentives that just don't line up properly.
And who bears the brunt of that?
Mostly retail investors. They hold something like 65% of all muni debt. And for them, the average cost just to buy and then sell a bond, the round-trip cost is about 1.1%.
1.1%. That sounds really high compared to, say, stocks.
It is. Compare it to maybe 0.04% for equities. And worse, there's massive price dispersion. Meaning you could see the exact same bond trading at prices that differ by 2% or even more on the same day, especially for smaller trades. It suggests a real lack of competition and transparency. It's like paying wildly different prices for the same gallon of milk at stores right next door to each other.
That doesn't sound very efficient.
Not at all. And that's just trading existing bonds. The problems start right when they're first issued. Municipalities often use negotiated underwriting, basically picking one bank to work with instead of having banks compete to offer the best price.
And that costs more.
The research suggests, yes, systematically higher borrowing costs for the cities and states, maybe 13 to 17 basis points higher in yield compared to when they use competitive bids. Less pressure on the underwriter, presumably.
Plus conflicts of interest you mentioned.
Right, with advisors, rating agencies. And then there are issues with how tax advantages are used or maybe not used effectively. An estimated $30 billion a year in potential federal tax savings just left on the table.
So wrapping up the bond markets, what's the call to action here, especially for munis?
Well, the authors are pretty clear. They're pushing for major reforms. Things like centralized trade reporting so everyone sees the prices, transparency around dealer markups, pushing for more competitive bidding on new issues, and generally just aligning incentives better. The goal is really to modernize that market and cut down those costs, which ultimately get paid by taxpayers and investors.
Okay, we've seen how rules shape SOEs and financial markets.
Yeah.
Let's pivot now to trade policy, specifically the U.S. trade war in 2018-19. We hear about the economics, but this next study digs into, well, perhaps a more political motive and its very real costs.
Yes, this research by Fagelbaum and others, it paints a pretty stark picture. The U.S. tariffs, they cut imports from targeted countries by nearly 32%, and then the retaliatory tariffs from other countries, they hit U.S. exports, causing about a 10% drop.
Okay, so trade definitely went down. What about the cost? Who paid?
That's the crucial part. The study found the costs were fully passed through, directly onto U.S. consumers and businesses buying imported goods, the total burden, a staggering $51 billion.
$51 billion, wow. And what was the net effect on the U.S. economy overall?
The estimate is a net real income loss of about $7.2 billion, which, as a percentage of the whole GDP sounds small, 0.04%.
Right, almost a rounding error at the macro level.
Exactly. But the big story, the really concerning part, isn't the total number, it's how that loss was distributed. It wasn't spread evenly at all.
So who got hit hardest?
Well, this is where the political angle comes in. The research shows the structure of the U.S. tariffs seemed designed to help industries located in politically competitive areas, swing counties, essentially.
So tariffs were targeted politically.
It appears so. And the flip side, the retaliation from other countries disproportionately hammered agricultural regions, which tend to lean Republican. The result was real wages actually fell for workers in those export-focused sectors, making regional wage inequality worse.
So the conclusion is, the trade policy wasn't really about economic efficiency. It was more about electoral strategy.
That seems to be the strong implication from the data, yes, that electoral considerations played a major role in how those tariffs were designed and implemented.
What does that tell us then about using trade policy as a political tool?
Well, it's a pretty stark reminder, isn't it? Protectionism, even if the overall hit to GDP looks small, can create major distortions. It hurts consumers, messes with supply chains, and it can really deepen regional divides when political goals override sound economic thinking. It highlights the risk of using economic policy for short-term political gains, potentially harming long-term prosperity and fairness.
A sobering thought. Okay, for our final deep dive, let's return to India. We're looking at the electricity market this time, where a really vital piece of the puzzle, a way to manage price risk, has been missing. Until now. I mean, imagine running a power plant or being a big factory using tons of electricity in a massive market like India's,
Yeah.
but having zero tools to hedge against wild price swings. That's basically been the situation.
Yeah, it's a huge problem. The source gives some great examples. Think of Mr. Akash running a power plant. He sells some power on long-term contracts, but the rest. Merchant capacity. Huge revenue uncertainty for him. Or picture a power trading firm in Mumbai. They see price patterns, but how do they manage their margins? No hedging tools. An aluminum exporter needs to bid on long contracts. How can they do that confidently if they can't lock in their biggest cost, electricity?
Right. These are real barriers, the source calls them barriers to scale, stability, and investment, and they all stem from this missing piece.
Absolutely, and the scale is immense. India's physical electricity market is enormous, over 1,730 billion units generated in fiscal year 2024. But compare that to global markets. In the EU, they trade electricity derivatives equivalent to over 12,000 billion units a year. That's 4 times their actual generation. The US markets trade over 3,000 billion units in derivatives. India had, well, basically nothing on that front.
So what held it back? Why no futures market?
It was largely a regulatory logjam. For years, there was a dispute over who had jurisdiction, the Central Electricity Regulatory Commission, CERC, or the Securities and Exchange Board of India, SEBI. But then came a breakthrough. In October 2021, the Supreme Court of India finally ruled CERC handles the physical side, SEBI handles the financial derivatives.
Ah, okay, so that cleared the path.
Exactly. It paved the way for introducing electricity futures and options.
And just remind us, how do these futures contracts work, basically?
They're pretty straightforward. They're cash-settled contracts. So two parties agree today on a price for electricity to be delivered at some point in the future. Crucially, no physical electricity actually has to change hands. It's about locking in a price, getting that visibility beforehand.
Okay, and the benefits seem like they'd ripple out to everyone involved.
Oh, immensely. For generators, like our Mr. Akash, he can lock in a base price for some of his power. That means more predictable cash flows, which makes lenders happier and protects him if prices suddenly tank.
And the buyers? Distribution companies, the discoms, big factories?
Yep, discoms can fix their procurement costs before, say, a hot summer hits and demand spikes, better cash flow management, maybe fewer emergency tariff hikes for consumers. Industrial users, like that aluminum exporter, they can lock in power costs months ahead, build that certainty right into their product pricing, bid more confidently on contracts.
And traders, financial players.
For traders, it creates arbitrage opportunities, helps them provide liquidity, makes price discovery more efficient, and for financial institutions, it opens up a whole new asset class. They can offer structured products, maybe help finance renewable energy projects by offering hedges.
So let's revisit those examples. Mr. Akash, the generator.
Right. Now, he can sell some of his future power on the exchange, say 15 days out, securing a base income.
A Mumbai trading company.
They can track the forward prices daily, buy futures to cover their commitments, and confidently offer fixed-price contracts to their own customers.
And the aluminum exporter.
They can now use futures to lock in energy costs for, say, 18 months out, allowing them to confidently bid on and win those long-term fixed-price export deals that were just too risky before.
It really sounds like a shift from just reacting to prices to actually planning around them. From firefighting to forecasting, as the source puts it.
Precisely. It's a fundamental change. Now, it won't be perfect overnight, of course.
What are the hurdles?
Well, initial liquidity will probably be low. It takes time for participants to get comfortable and for prices to become really reliable indicators, realistic price discovery, they call it. There's also a risk that regulators might be overly cautious, maybe restricting access initially, which could slow down how the market evolves. But the source sees these as, real but surmountable challenges.
Because the need is just so great, right?
Absolutely. Electricity is just too vital, too prone to volatility, and increasingly complex with renewables and distributed generation coming online. Operating without these financial risk management tools just isn't sustainable. This development is seen as really crucial for deepening India's power market reforms, helping the transition to cleaner energy, and just creating a fairer, more balanced market for everyone.
So reflecting on everything we've discussed today, from giving SOEs autonomy in India to the structure of U.S. bond markets, the politics behind trade tariffs, and now introducing futures in India's power sector, it's really clear, isn't it? The design choices we make, the rules we put in place, they have these incredibly profound, very real effects on how our economies actually work day to day, and on the bottom line for businesses and for individuals like you.
Exactly. This whole deep dive, it just hammers home that markets aren't just these natural organic things that spring up. They're also, sophisticated architectures. They're built, shaped by human decisions, regulations, innovations, and understanding the why behind those designs. Why is a market structured this way? Why this regulation and how those designs interact with actual human behavior? That's just essential if you want to navigate this complex economic world we live in.
So the final thought for you, the listener, is this. If the hidden design of a market, whether it's bonds or electricity or trade, can have such massive impacts, what other invisible architectures might be out there? What unseen rules or structures could be shaping the systems you interact with every single day? Maybe even influencing your own choices, your own opportunities in ways you haven't considered. Definitely something to chew on.